I'm going to be showing you guys a strategy. A strategy very, 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 very simple, yet very, very profitable and very, very effective. A strategy very simple. Even your granny can be able to make money with that Forex trading strategy. A strategy very mechanical in a way. You don't need to know too much about the technicalities of the Forex market, the ups and downs, the advanced terminologies of the Forex. Just follow the ins and outs, the rule-based. Remember, a rule-based strategy. Just follow the rules and you make money in the Forex market. Just follow the rules and you see testimonials like this. All these testimonials you are seeing, these are traders that are getting paid out using the same strategy I'm going to be teaching you guys on this video today. And the name of the strategy is known as GUMVRO, coming up right now. We're going to be using our MetaTrader 5 as always. And in MetaTrader 5, you guys know how organized I am when it comes to trading. I have different profiles for different strategies. You can see the profile is already here, GUMVRO, the Godlove University Moving Average Strategy. I'm going to delete these moving averages and we're going to set everything up together. All right, so I'm going to delete this, and again, I'm just going to delete this. Good. So you need a clean chart just like this one. We're going to start on Go so that you guys can see how it works. You need a clean chart just as this one, and it needs to be the 1 hour time frame, and it needs to be just as clean as mine. Nothing, no fancy indicator, nothing that is going to be telling you the market is buying, another one the market is nothing, none of that bullshit. All right, all these your gurus trying to confuse you here and there, trying to say what they don't even understand how it works. We're cutting all of that crap and showing you guys simple what it works based on market dynamics. Simple. So you just need a clean chart like mine. Make sure it's clean, nothing on it. Now, if you're an advanced trader like me, there are different methods you can use to be able to know if the market is buying or selling. Like, for example, if I'm just looking at this chart, I can already see the market was printing. If I can just go here, I can see clearly the market was printing, you know, lower lows, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. And if I can mark this, you can see clearly we had a clear uptrend right there. So I can just see clearly this market, the gold chart has been in an uptrend on the 1 hour time frame. But if you're not as advanced as me, you need a tool, and I'll advise you. Even I myself, I just prefer to use a tool sometimes, so that I just drop it on my chart and it shows me anything. It just shows me everything I need to see without me trying to second guess. So that's why it's just advisable for you to use a tool. So I'm going to delete this, and those two tools that are going to tell you whether the market is buying or selling are known as moving averages. And how are moving averages formed? I'm going to show you guys really quick. A moving average, if we are using the 1 hour time frame, what they do is they take the price, or they take the opening and the close of the market candle on that 1 hour time frame, and they put it as a dot. All right, they put that price, the average price, the median of that price as a dot. They measure another one again, they put it as a dot, and with that dot, they're plotting time against price. So they just put it as a dot again. The next one, they put it as a dot. The next one, they put it as a dot. The next one, they put it as a dot. And what do you do? If you are someone who did statistics in high school or the university, you know, after that, you need to link all those dots. When you link all those dots, it produces a line. If that line is sloping upward, it gives you an upper trend. If the line is sloping downward, it gives you a lower trend or a bearish trend. That's how moving averages work. And now the period is going to be able to now tell you how fast the moving average can react to price change. That's why we use different periods to then trade this particular strategy. All right. That's why you then need different periods, because different period reacts differently to price change in the Forex market. So after explaining the dynamics behind moving averages, let's put them on our chart. In our case, we're not going to be using simple moving averages. We're going to be using exponential moving averages. So just go under indicators and just search for moving average exponential. Simple. It's already there. I already put it on favorite so that I can use it all the time. So click on it. It's going to be on your chart. All right. And then click again. You're going to have two on your chart. If I delete this, you can see I have two right here. I have one with a period of 9 and another one with a period of 9. We're going to set all of this. So the first one, we're going to put it period. Let's just go here, click here, and then we go on settings. The first one is going to have a period of 10. So you can just pause the video and put the same settings. Source, we're just going to use close. All right, because in most cases we used to use median and most of you guys will be confused. But anyway, let's stick to median because median reacts faster to price. So median here is high plus low divided by 2. Very, very important. High plus low divided by 2. H plus L divided by 2. And then we're just going to go on style. We're going to leave the color like that. Okay, boom. And then let's put the thickness on 2. And then we click on OK. Voila. So we have our 10 exponential moving average. You can see 10 is right there. We click on the other one, go on again on settings. And this one, we're going to put it on 23. All right. We're going to put the period on 23. 23, again, H plus L divided by 2. And this one, the color is going to be red. So we need to put a red color on this one. Voila, that's it. We put the red color, put it again on 2, and then we can then confirm. Voila. Boom. That's it. So without even going far, you can already see, so long as you see the two moving averages sloping upward, that's an uptrend. And anytime you see them sloping downward like here, that was a downtrend, that was an uptrend. And again, anytime you see the fast moving average, the moving average with a period of 10 is a fast moving average, and the one with a period of 23 is the slow moving average. Now, someone will say, oh, Godlove, you have two moving average. One is having a higher period and the other one is having a lower period. How can you say the one with a period of 10, which is the blue one, is instead the faster moving average, and the one with a period of 23 instead the slower moving average? The moving average with a smaller period reacts faster to price changes as opposed to the moving average with the higher period. That's why in most cases or in all cases, you will see us calling the moving average with a smaller period, like in our case, the 10 exponential moving average, the faster moving average. So when do you get, because now the main question is, how do you get signals, buy or sell signals using these strategies? It's simple. Anytime the fast exponential moving, anytime I just mention a fast exponential moving average, I'm talking of the moving average with a period 10 or the blue moving average. And anytime I talk of the slow exponential moving average or the slow moving average, I'm talking of the moving average with the period 23 or the red exponential moving average. So when do you get a buy signal or when do you get a sell signal? Anytime the fast exponential moving average cross over the slow exponential moving average from below, that's a buy signal. So you would have gotten in right here. This would have been our buy signal. At the close of this candle, that would have been our buy signal, stop loss right here. And we go for a risk to reward of 1:2. Boom, we would have already been out of this trade. And when do we get a sell signal? We get a sell signal anytime the fast exponential moving average cross over the slow exponential moving average from above. In our case, it would have been right here. So this would have been our sell signal right here. We would have gotten in on a sell by the close of that candle right there. Stop loss would have just gone somewhere here. We go for a risk to reward of 1:2. We would have almost hit this particular one, and you see the market retrace against us. Because if we're going for 1:2, the market retrace against us after moving in our favor for almost about 1:1.8. But that is it. That's how you just follow your strategy. There are some that are going to be winners. There are some that are going to be losers. If we go behind a little bit, you can see there are many signals just looking like this. I can already see the market was bullish because you can see the fast is above the slow. So the market was bullish all this while. And the first bullish signal was confirmed right here when this fast moving average crossed over this slow moving average from below. So that would have been a buy signal right there. We would have gotten in directly here. Stop loss just goes below the candle here, and we go for a risk to reward of 1:2. Boom, we would have already been out of the trade, 2% of our account. And remember, all these strategies I'm already explaining, assuming that you understand the concept of a risk management. Because with this strategy, even if you have a 40% win rate, you are still going to be able to make money. You are still going to be able to pass your challenges. You are still going to be able to have payout, period. All right? Because just see, from the examples I've shown you guys, we had 2 winners and 1 losers. 2 winners and 1 losers. Those 2 winners is 2 times 2% because we are risking 2% per trade. That's 4% of our account. And 1 winner is just 1 times -1, which is -1 and +4. So at the end of the day, what's our net of the day? +3%. So even though we had a loser, we are still up with plus 3% of our account for that day. If it was a $100,000 account, that's plus $3,000, even though we are having losers. You see, so that's why I say I'm just assuming you guys already understand the concept of risk management, risk and money management, which I explained earlier. If you just go behind again, this would have been a sell signal right here, which is when this moving average crossover, the fast crossover, the slow from above. So we would have entered somewhere here by the close of this candle. You wait for the candle to close. So it would have been this one right here. Our stop loss would have just gone above this candle here. And we go for a risk to reward of 1:2. Boom. That is it. We would have already been out of the trade. Still a big winner. All right. So you can see the strategy is mechanical. You're just following, you're following your rules. That's when they call it a justified win or an unjustified win. Anytime you have a win, the main question, was it a justified or an unjustified win? A justified win is the one you follow all the steps on your trading rule or on your trading strategy or your trading plan. A trading plan is like a checklist, which when you see everything checked before you can take a trade. So you need to make sure all the boxes on that checklist are ticked before you can take a trade. Number one, what is the direction of the market? I'm going to confirm the direction of the market using my moving averages. Number two, if the market is already going in a predetermined direction, how do you get into a trade? Now, this is when another tool is going to come in, all right? Because I was just showing you guys a typical example when, we just have a cross, you confirm and you take your signal. What if you come when the market, is already sloping upward like this, when, the market is already going up and up and up? When do you jump into the trade again? That's when you need a tool that will tell you the extent to which the market can retrace against the original direction before resuming the original trend. And that tool is known as the Fibonacci tool. So that's when we need the Fibonacci tool. And the way the Fibonacci tool works is very, very simple. I'm just going to demonstrate again. All right. Let's just say the market is going up like this. You have an upper trend like this, like this, like this, like this, and like this, right? Good. In most cases, you have our moving averages will be able to cross somewhere. You have your moving averages somewhere like this, where you have, the fast crossing over this, and, you just have the two moving averages sloping upward like this. You have something typical like this. Now, at this place where the moving averages cross, you normally have your buy signal. So you enter on a buy somewhere here, stop loss, and that will be a first win. Now, when you hit that first TP, when do you join the trade again, or when do you take another trade? You're not just going to sit on the sideline and keep watching the market just keep printing and going in the original direction. You need to know when you can jump into that particular trade again. That's when you bring your Fibonacci tool and you now check the most recent swing low, most recent swing high, most recent swing low, most recent swing high, most recent swing low, most recent swing high, just like that. So in our case, if the market is already, let's say, somewhere here, this will be our most recent swing low, this will be our most recent swing high, if the price is somewhere here. And what you do is you then bring in your Fibonacci tool from the most recent swing low to the most recent swing high, and you wait for the market to do what? To push right down to three levels, your 38% level, 50% level, or the 61% level. I'm putting it in percentages so that it can be easy for me to pronounce. So 38% level or the 0.38. 0.38 is too long for me. So I just put it at 38% level. The 0.5 or the 50%. 0.61 or the 61%. So long as the market can push down to any of these three levels and then close bullish, you're going to be taking another bullish signal. All right. If the market is bullish, you're only looking for bullish signal. You don't want to swim against the current. When it says swimming against the current, when the market is, when the river is coming down and you're trying to swim upstream. It's not possible. You're not going to be able to swim upstream. Or you're trying to catch a falling knife. It's not possible. It's going to hurt you. It's the same thing in trading. If the market is going up, you're all going to be trading in a bullish market. Or you're all going to be looking for bullish opportunities. If the market is going down, you're all going to be looking for bearish opportunities. So in our case, we already confirmed the direction using our moving averages, and we are only looking for bullish opportunities. And the next opportunity is going to be given to us using the moving average. So in this case, you can see the market did push down to, let me just extend this to the left so that we can see how far. So the market did push down to our 61% level and close bullish according to this hypothetical example. So we would have taken a buy signal right here. We would have taken a buy signal right here. Stop loss would have gone here. Risk to reward of 1:2. Boom. We would have already been out of the trade. As soon as we are out of the trade, we just do the same thing. You ask yourself, where is the most recent swing low? It would have been here. Where is the most recent swing high? It would have been here. So your fib would have then run from here to here. All right, and then you wait to see if the market would have pushed down to your 38% level, and in our case, you can see it pushed down to 38%. It might not reach 50, it might not reach 61. So long as it reach 38% and then close bullish, you're going to be entering again another buy signal right here. So this would have been another buy trade right here. Another buy trade right here. And then boom, you put your stop loss here, go for a risk to reward of 1:2. You would have already been out of that trade. You see, so this is when you have a bullish trend. Now, conversely, if you have a bearish trend, you will see the market doing this. And in most cases, you will see something like this, where these moving averages will cross and they're just sloping downward like this. At this cross, this will be a confirmation of the first signal. But now, you ask yourself again, most recent swing low is here, most recent swing high. Most recent swing low, most recent swing high. Most recent swing low, most recent swing high. So in our case, if the market is already here, this was our most recent swing low, this was our most recent swing high. So our fib is going to come from here to here. And then that's it. From there to there, and then wait for the market to get to those our key levels, which was the 38, 50 or 61% level. And then if it close bearish, and then we're going to take a sell signal. The same thing, if it comes here, the next fib is just going to run down from where? Then our next fib is going to run from here to here. And if the market can push down to a 38% level, 50 or 61, boom, we're going to look for another sell signal. That's why you're just going to keep getting in and out of the market, in and out of the market. The market gives you a signal, you get in and out, get in and out, in and out. Boom. So that is a hypothetical example. Now let's see on the chart what I just explained. Let's now see it on the chart. All right, and then we're going to do like a replay to actually see how we would have made money with what I just explained. Let's see. Okay. We can just do replay trading to see what actually happened, right? I would like us to do replay trading. So the replay trading, launch replay bar. So let's start our replay trading from here. Launch, start new. Let's go to start new. And let's start our replay trading right here. Let's start it right here. All right. So with this, we're just going to minimize this. Let's minimize this. Perfect. Okay, so with this, so we just press. You see the market is actually printing. I'm going to put this at the center so that you guys can see, right? We already had a confirmation. This is our first. Remember, we are trading as if we're in the market that day. Replay trading is going to cancel everything that has happened, and then we're going to trade as if we're in the market that day. So our first cross was here, meaning we would have already been in this trade by the close of this candle. Would have already hit our take profit ever since. So since we have already hit our take profit, let's look at where we would have gotten into this trade again. This would have been down where our most significant swing low would have been there, significant swing high would have been here. So even if we plotted our fib, we can already see very clearly. Let me show you this. Our fib would have then run from there to there. And you can see the market did push down up to our 61% level, and it's about to close bearish. This candle, you wait for the candle to close. This candle here is about to close bearish. But in some cases, if the bearish candle is too long, I let the trade go. You know, I let it go. I go to another setup. I go to another currency pair. So this one is becoming too long for me, too long for my likeness. So let's continue going ahead to see what actually happened after that. Okay, voila. Okay, you see that. So when the candle is too long, for example, this was the close, the bearish candle would have entered on a sell here. This one would have been more like a loss, because you can see the market is actually pushing against us. So that's what I'm saying. If the candle is too long, It means the momentum is too high for me to easily risk. So in that case, I can let the market go. So let's go. I'm only looking now to see if I'm going to get a confirmation of a sell signal, of a buy signal. All right. Perfect. I just got a confirmation of a buy signal, which is a cross right here. This is a cross right here. So by the close of this candle, this would have been a confirmation of a buy signal. So we're entering on a buy. This is a buy right here. By the close of that candle, I'm just going to be risking. So since this is go, I'm going to be risking about, about 100 pips or 150 pips. Let's risk about 120 pips. I'm seeing the pips right here. So let's go to see if we would have hit take profit on that one or not. Okay, let's go ahead. Okay, let's go. Boom. So take profit was hit on that one. Was that a risk to reward or 1:2? No, let's increase. Remember, we're going for a risk to reward of 1:2. Yeah, take profit was hit because risk to reward of 1:2, that was take profit hit right there. So as soon as take profit is hit, remember what I explained earlier, you then mark what? Your most significant swing low will be here. And you're waiting for when the market will start retracing against the original trend. The original trend is a bullish trend. So you're waiting for when the market is going to start doing this, start pulling against you, and then the FIB is going to now determine how the extent to which the market can push against the original trend before resuming. So in this case, let's continue going to see when the market can start retracing against the original trend. Perfect. That's it. I can see very, very clearly that this was when the market started retracing against us. So our FIB is going to run from here to here. So let's drop our FIB from here to here. And you can see very clearly the market has already pushed down to our 38% level. So let's now continue to see when we have the next bullish candle. As soon as we have the next bullish candle, that will be a bullish signal. Perfect. It even drops right down to our 50% level. Let's go. You're just playing the waiting game. More money is made in Forex trading waiting than actually trading. So we haven't gotten a bullish signal yet. That's it. Let's go. You keep checking until you get a bullish signal or a bullish candle close. That's a bullish candle close right there. That's a buy, a very big buy signal right there. So you keep watching. And why watching and waiting for a bullish signal? If then the moving averages cross, when the fast moving average cross over the slow moving average from above, remember that will give you a sell signal. So everything you've learned from looking for a buy signal will be thrown over the window, and now you're only going to be looking for sell opportunities because you only have to trade in the direction of the trend. It's simple, only in the direction of the prevailing trend. Now that's our buy signal, so we're going to come here. Our long trade is going to come there. Stop loss is just going to go below that candle, which is about 120 pips. And then we go for a risk to reward of 1:2, which is right there. Let's see if this one was a winner or a loser. Let's see. That's it. That's it. Boom. Boom. That's it going in our favor. That's it going in our favor. Almost draw. Okay. We are still in the game. Perfect. Boom. Look at that. Just this candle here, and we already hit TP. Just from the back testing we've done, we've already made 2% of our account. Remember, our first trade was right here at the cross, 2% hit, and then we use our FIB. The market pushed down to our FIB's level, close bullish, we enter again, boom, 2% hit. So now, this area here becomes our most significant swing low. We are looking for the most significant swing high so that we can bring in the FIB again to see if we can get another buy opportunity. So let's go. Let's go. Let's keep pushing. Let's go. Let's go. Perfect. That's the market pushing against us. So we're going to draw our FIB to see if the market did respected our FIB levels. So you see, the market hasn't pushed right down to the 38% level. So even if this one closed bullish, we're not going to be taking the trade because the retracement is not yet right down to the elastic level we're looking for. So we're looking for a reasonable retracement for the market to resume. This session is just called a retracement. In Forex trading, it's called a retracement, a retracement, a retracement. Because anytime you enter a trade, the market doesn't just go like a slingshot and hit your take profit. The market breathes out, breathe in, breathe out, breathe in. So when the market is breathing in, you need a tool that can tell you the extent to which the market can break in before resuming the original trend. So that's why we need this particular tool right here, which is known as the Fibonacci or the Fibonacci tool. So in our case, we're going to continue going because, you know, the market didn't push right down to our Fips level. So let's continue going. Let's continue going. Let's continue going. Let's continue going. Let's go. The market hasn't pushed down to our Fips levels. And boom, now this area, you can see this. Let me show you guys this. So this area now is violated. So our most significant swing low now is here. This is our most significant swing low, and we are now waiting for the next significant swing high to print. So let's go. Let's go, let's go. Boom, boom. Perfect. Okay, it didn't print. It needs to actually start pulling against us, and then we're going to plot in our feet. Look at that. Look at that. Can you see that? Can you see that? Can you see that? So let's see. Let's see what we got here. Our fib would have run from here to here. So you can see the market already pushed right down to a 61% level, even past 61% level, and we are just looking for now the next bullish candle. So let's go. Let's see when we're able to have the next bullish candle. Perfect. That's it. That's it. That's it. That's it. That was the next bullish candle right there. Remember, we've already made 4% of our account. This is the next bullish trade right here. Stop loss is just here, and we are going for a risk to reward of 1:2. 1:2. That's it. Let's see if this one was a winner or a loss or a loser. Okay, okay, okay. All right, we're in profit. We're in profit. We're in profit. Let's go. Let's go. That's it. TP hit. TP hit, TP hit, TP hit. That's 6% of our account. We haven't had any loser yet. So now, since TP has hit, our most significant swing low now is here. So this is our most significant swing low right here. And we are now looking for what? Next significant swing high. So let's wait for when the market starts retracing a little bit against us. Let's go. Now, okay, that wasn't it. Let's go. Let's go. Let's go. All right, that's it. That's it. That's it. That's it. So our most significant swing high now is right there. So our fib is going to run from here to here. We now wait. The market has already come right down to the 38% level. And if anytime we have now a bullish candle, we're going to be taking another bullish trade. You're just doing this like, you know, a plan, you know, take your time. I used to always say, analyze like a pro and execute like a robot. Analyze like a pro and execute like a robot. Once you see your signal, you don't need to second guess because you don't know the outcome of that trade. No one knows the outcome of that trade. No one can predefine the outcome of that trade. You only have, your strategy is only there to tell you if there's a high probability of the market going in your favor. We can still be in this trade and there's a fundamental news somewhere in the United States. There's a fundamental news somewhere in that particular economy we are trading. Remember, when you're trading Forex, if you are trading two currency pairs, you are trading two economies. Any fundamental that happens in any of those economies is going to directly affect your trade. So anything can happen. This is gold and it's XAU USD, meaning it has the United States economy. Anything that happens in the United States economy or in USA can directly affect my trade. And there's nothing I can do. I can't control the outcome of that trade. The best I can do is just to manage my rate or to predefine my risks before getting into that trade. So that is it. That is it. So let's wait for the next bullish candle to see if we would have taken another bullish trade. Voila! You see that drop. You see that drop and then bullish close. So we would have taken a bullish trade again right here. Remember, we are already up with 6% of our account. We are going for a risk to reward of 1:2. Let's see. Okay, let's see if this one was a winner or not. Okay, all right, all right, all right, okay, all right. Let's see. Perfect. This one was a loss. You can see it hits our stop loss. And by the time it hit our stop loss, we already had a cross right here showing you guys that, oh, the bullish trend is already finished. The buyers are already exhausted. Now the sellers have come into the market. So we are not more looking for a sell opportunity. We are only looking for, we are not more looking for a buy opportunity. We are only looking for a sell opportunity at this point in time. So since we are already here, this will become our most significant swing low. We are just waiting now to see if the market can bring the most significant swing high. Okay, let's see. That's too small for me. That's too small for me. All right, let's go. All right, I like that printing. Okay, so this one, since it's already clearing this high right here, I'm just going to keep playing to see what happened after that. Okay, that's inside a bullish cross. That's a bullish cross. That's a bullish cross right there. So we are back to looking for our buy opportunities. We are back to looking for our buy opportunity. We're going to have a buy right there. Stop loss is just going to be here, and we go for a risk to reward of 1:2. That's it. Let's see what happened. Okay, this one was a loss. This one was a loss because our stop loss was very tight. So this one was actually a loss, but it's fine. By the time it was a loss, we would have gotten into this trade again because our fib is now going to run from here. So we are now down to 5%. Remember, we're always plus 6%. Our fib is going to run from here to here. And if we plot that, you can see very clearly this area, the market already pushed down to our fibs and closed bullish. So we're going to enter again a bullish trade right here. This is going to be a bullish trade right there. Stop loss is going to go right here. And we go for a risk to reward of 1:2. So let's see if it was still a loss again. And even if it was a loss, who cares? I'm already up plus 5%. So let's go, let's go, let's go, let's go, let's go, let's go. Was it a win? Was it a win? Yo, this is the longest we stayed in this trade. Boom! Almost hit our TP. I think this one would have hit our TP. This one would have hit our TP because remember, we are going for a risk to reward of 1. That's it. This one would have hit our TP. It would have hit our TP. That I'm too sure. So that's a win. 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 Let's see. Let's see. You see, it keeps respecting that area. So that would have been a big win. That would have been a big win. We are back to plus 7%. We are back to plus 7%. We just keep doing that. Let's be fast now to see what actually happened. All right, to see what actually happened. Okay, that was a cross sell signal right there. So let's see. That one would have been a loss. Buy signal would have been here. Let's see if we would have win with that one. So remember, this one here sell would have been a loss. So we are back to plus 6%. And then I got a buy signal right here. So stop loss would have been here. And then we'll go for a risk to reward of 1:2. So let's go. Risk to reward of 1:2 right here. So let's go. Let's see what happened. Let's go. Boom. That one would have been a big win. Big win right there. Big win right here. Let's go. Big win right there. So we are back to plus 8% of our account. Plus 8% of our account. And this area here becomes our most significant swing low. So we are looking for our next significant swing high so that we can bring in our fib. So let's go. We're going to backtest to the current date. To the current date. Okay. That's it. That's our most significant swing high right there. So our fib is going to run from here to there. Let's see if the retracement was reasonable for us to get into the trade. Okay, that area was violated. That area was violated. So we continue. We just keep watching the market. We keep watching the market. Boom, boom, boom. All right. So again, our fib would have run most significant swing low, most significant swing high. So remember, you're doing this on multiple pairs. So even if you come to this one and you don't see a setup, there will be a setup on another pair. That's why you don't worry yourself. I would have, so no, I'm one of those people that I will never advocate for you to just focus on one currency pair. No. What if you come to that currency pair and there is no trade to take? That's when you see traders start squeezing to take a trade. Even when there's no signal, they'll start squeezing to take a trade. So that's why you're going to be doing this on NATDAQ, on Great Britain Pound USD, CAD JPY. You know, it works on all assets. All assets. So let's see if the market did push down to our 38% level. It didn't reach on our 38% level, so we're going to let that one go. We need the market to push to our 31% level. Boom! 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 So that's an entry right there. That's an entry right there. It did push right down to our 50% level and close bullish. So we're going to enter on a buy here without even thinking, without second guessing. Don't second guess when it comes to trading. If the setup has already presented itself, pull the trigger, bro. Pull the trigger. Pull the trigger. Please don't second guess. Don't second guess. What is going to happen is going to happen. I don't care if it's a winner or it's a loser. I already know my strategy is having an edge. At the end of the day, I'm going to still make more money because there's an edge on my strategy. If I have even more losers than winners, I'm still going to make money because there is an edge on my strategy. That's the secret to profitable Forex trading. So let's go. Let's see if we hit TP on this one or not. All right. Boom, TP hit right there. TP hit. That's it. And now, this will become now our most significant swing low. That's 10% of our account. If it was a profit account, you've already passed phase 1. That's 10% of our account. So our fib is now going to run from here to here. And we wait again. That's already 38%. Closing bullish, meaning we're going to enter again on another buy right there. This is going to be another buy trade. Stop loss right there. And we go for a risk to reward of 1:2. That's it. Let's see if we would have hit TP or not. That's it. Okay. That's the current market price. It brings us to the current market price of today. So we would have still been on a buy on this particular one because this is the price, the current market price, December 24th, and you can see right there, this is the current market price as we speak. So by now, we would have still been on this setup, waiting for it to go on our favor, hit our TP, or change the direction and start moving against us, and then we'll be able to confirm once the moving averages have crossed if it has changed from a bullish market to a bearish market. That's it. That's it. The strategy is that simple. It's that simple. And I've shown you guys examples on both buy and sell signal, bullish and bearish signals, an upper or a downtrend, anything. Go to another asset, go to NASDAQ. You're going to see the same thing. Look at NASDAQ, bro. Look at NASDAQ, the same moving averages. We would have gotten our entry right here on a buy. Boom, hit our TP. Our moving average, our fib would have run down from here to here. This area here would have been around our 50% level. We would have entered at the close of this candle, stop loss here. TP would have hit again here. Boom, this would have become our most significant swing low, significant swing high. This would have been around our 38% level. Would have entered at the close of this candle, stop loss here. Boom, hit TP right there. Go on any asset, bro, any asset. Check anyone, catch JPY. The same thing. This would have been the cross of the candle. Buy signal would have been here. Stop loss here. TP right here. Risk to reward of 1:2. Pulling back here. Fib would have run from here to here. This would have been around our 38% level. Closing bullish would have entered on a buy there. Stop loss. TP hit. And then this would have been a confirmation of a sell. Would have entered on a sell there. Stop loss there. Risk to reward of 1:2. Boom. Would have already been out. Simple. 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 This is the GUMVRO strategy. If you see all these testimonials, people saying, "Oh, I just got this payout." These people say, "I just got this, All these payouts you are seeing, the strategy they are using, GUMVRO. If I can say, my channel and Godlove University has produced 10,000 traders or 10,000 profitable traders. This strategy alone has produced about 8,000 profitable traders. That's it. It's mechanical, methodological. You don't need to do anything. Just follow the process. You have tools that are telling you if the market is going up or down. That's your moving averages. And if the market is already in a prevailing trend, either going up or down, you need another tool that's going to tell you the extent to which the market can retrace against you before continuing the original trend, which is the Fibonacci tool. And I've still shown you guys how you can use it. Guys. Watch this video as many times as you can and start practicing. Let me know in the comment section any challenge you have when it comes to this strategy. Any challenge you have when it comes to making money with this strategy. My goal is to see traders making money with this strategy. Share your experience, good, bad, or ugly. If you are still facing challenges, I'm going to assist you. If you've already grabbed it, share your experience on the asset you are using to trade. Share your experience on the payout you got. Share your experience on the funded account you passed. Share your experience on the video description, because together, that's how the motto for Godlove University is: prospering together. Prospering together. Together, we're going to make this money in the Forex market. The Forex market is having about $6.6 trillion, trillion with a T, per day. Meaning there's enough money for everyone, bro. There's enough money for everyone. The fight is with poverty. not with one another, bro. That's why when it comes to the Forex market, you will never hear me beefing with this one, because some of your Forex mentors, they've turned the Forex market like a music industry where this artist is fighting with this one. You will never hear me. Pat, call my name and you won't see me, bro, because it's not worth my energy. My goal is to impact your life. My goal is to show you the way. My goal is to hold your hand. That was always my prayer. God bless me to bless another person. Show me the way to show another person. Impact my life to impact another person's life. Show me Forex and I'll teach another person. So guys, I'm glad I've been able to present this in a way you guys can understand. Go back, get trading view. Let's start backtesting this strategy. Let's go. And I'm going to see you guys on the next strategy.